Hello and welcome to the Tellone Perspective. I'm Dean Tellone. In our last episode, we walked through the traditional mortgage process, the paperwork, the credit scores, the debt-to-income ratios, and the 30-year fixed rates. That is the path most people take when they buy a home. But what happens when that path is blocked? What happens when a bank looks at your application and says no? Or, looking at it from the other side of the table, what happens when an investor wants to earn a steady return backed by real estate without actually having to buy, fix, or manage a property? Today, we are going to explore the answer to both of those questions. We are going to take an inside look at the world of private mortgage lending. Over my 50 years in financial services, I have seen the mortgage industry evolve dramatically. I have seen interest rates hit 18% in the early 80s, and I have seen them drop below 3% in recent years. But one thing has remained constant. Traditional banks have strict rules. If you do not fit perfectly into their box, they will not lend to you. Private lending exists to fill that gap. It is a massive, multi-trillion-dollar industry, yet it remains a mystery to most people outside of the real estate business. Today, we are going to demystify it. We will talk about how it works, who uses it, the risks involved, and why it plays such a crucial role in the broader real estate market. Let's start with a basic definition. What exactly is a private mortgage? A private mortgage is a loan secured by real estate, just like a traditional mortgage. The difference is the source of the money. Instead of borrowing from a large bank or a credit union, you are borrowing from a private entity. This could be a high net worth individual, a family member, a specialized private lending company, or a group of investors pooling their money together. Because these lenders are using their own private capital, they do not have to follow the strict federal guidelines that govern traditional banks. They set their own rules. They make their own decisions. So, why would someone choose a private mortgage over a traditional bank loan? The answer usually comes down to three things: speed, flexibility, and the property itself. Let's talk about flexibility first. Traditional lenders focus heavily on the borrower. They want to see a high credit score, usually above 620. They want to see 2 years of steady W-2 income. They want a low debt-to-income ratio. Private lenders take a different approach. They are primarily asset-based lenders. While they do care about your ability to repay, their main focus is the collateral, the property itself. They ask one fundamental question. If this borrower stops paying and I have to foreclose, is there enough equity in this property for me to get my money back? Because they focus on the asset, private lenders can work with people who banks turn away. For example, consider a self-employed business owner. Maybe they run a very successful company, but because of how they write off expenses on their taxes, their official income looks too low to qualify for a bank loan. A private lender can look at their actual bank statements, see the cash flow, and approve the loan. Or consider someone who had a medical emergency that temporarily damaged their credit score. A bank might automatically reject them based on that 3-digit number. A private lender can look at the whole story, See that the person has a strong income and a large down payment, and make the loan. The second reason people use private money is speed. A traditional mortgage can take 30 to 45 days to close. There are committees, underwriters, and endless requests for documentation. A private lender can often close a loan in a matter of days. This speed is exactly why real estate investors rely so heavily on private money, often referred to in the investment world as hard money. Imagine an investor finds a distressed property, a house that needs a lot of work. The seller wants cash, and they want to close in 10 days. A traditional bank will not finance a house that needs major repairs, and they certainly cannot close in 10 days. The investor goes to a private lender. The lender appraises the property, looks at the investor's plan to fix it up, and funds the loan quickly. The investor buys the house, renovates it, sells it for a profit, and pays off the private lender. This brings us to a very important point: the cost of private money. Flexibility and speed do not come cheap. Private mortgages are significantly more expensive than traditional bank loans. While a conventional 30-year fixed rate might be sitting around 6 or 6.5%, a private mortgage will typically carry an interest rate between 8 and 15%. The fees are also higher. A bank might charge a 1% origination fee. A private lender might charge 2 to 5% upfront. Furthermore, private loans are rarely 30-year commitments. They are usually short-term bridge loans, lasting anywhere from 6 months to 3 years. Many of them are structured as interest-only loans, meaning your monthly payments only cover the interest. At the end of the term, the entire principal balance is due all at once. This is called a balloon payment. Because of these high costs and short terms, a private mortgage is almost never a permanent solution. It is a stepping stone. If you take out a private mortgage, you must have a clear exit strategy. How are you going to pay off that balloon payment when it comes due? For a house flipper, the exit strategy is selling the renovated property. For a self-employed home buyer, the exit strategy might be using the private loan to secure the house now and then refinancing into a traditional bank loan in 2 years once their tax returns show enough income. If you do not have a realistic exit strategy, a private mortgage can become a financial trap. Now let's flip the table. We have talked about the borrower. Let's talk about the lender. Why do people invest their money in private mortgages? In the investment world, this is often called trust deed investing. When a borrower takes out a loan, they sign a promissory note, which is the promise to repay. They also sign a deed of trust, which secures that promise against the property. Investors are drawn to trust deeds because they offer a way to earn passive income backed by a hard asset. If you invest in the stock market, your investment can lose value overnight based on a bad earnings report or global news. If you invest in a trust deed, your investment is secured by a physical piece of real estate. Historically, trust deed investors have earned returns ranging from 7 to 12%, depending on the risk level of the loan. In a world where savings accounts and bonds often yield much less, that is a very attractive return. But it is not without risk. The biggest risk, of course, is that the borrower stops paying. To protect themselves, private lenders rely heavily on the loan-to-value ratio, or LTV. They rarely lend 100% of a property's value. Typically, a private lender will cap their loan at 65 to 75% of the property's appraised value. Let's say a property is worth $500,000. A private lender might only lend $350,000, which is a 70% LTV. The borrower has to bring the remaining $150,000 as a down payment. That $150,000 is the lender's protective cushion. If the borrower defaults and the lender has to foreclose, they have a large margin of safety. They can sell the property, even at a slight discount, and still recover their entire $350,000 investment plus any legal fees. This is why private lending is fundamentally different from unsecured lending like credit cards. The real estate provides a safety net. Private lending plays a vital role in our economy. It provides liquidity to the real estate market. It funds the renovation of aging housing stock, turning dilapidated houses back into livable homes. It helps entrepreneurs and self-employed individuals achieve homeownership when traditional systems fail them. But it is a sophisticated financial tool. Whether you are borrowing private money to fund a project or investing your capital into a trust deed to earn a return, you have to do your homework. You have to understand the terms, the costs, the legal structure, and, most importantly, the exit strategy. If you are considering borrowing private money, my advice is to consult with a real estate attorney. Have them review the promissory note and the deed of trust. Make sure you understand exactly what happens if you are late on a payment, and make absolutely sure your plan to pay off the loan is realistic. If you are considering investing in private mortgages, start small. Work with an experienced mortgage broker who specializes in private money. They can handle the underwriting, the appraisals, and the legal paperwork, ensuring that your investment is properly secured in the first lien position. The mortgage market is vast, and traditional banks are only one part of it. Understanding private lending gives you a broader perspective on how real estate is actually financed, bought, and sold. Thank you for joining me today. I hope this look into private mortgage lending has been informative and helpful. I'm Dean Tellone, and this has been the Tellone Perspective. I'll see you next time.